the old saying, like the trend is your friend until it ends, which is why you want to have some kind of active, if you're going to trend follow, you have to have some kind of active off ramp, right? To select.
Yeah, trend following is a great example. It's one of my favorite strategies. The way trend following works at its most basic levels, you're getting access to global equity markets, global bond markets, global currency markets, and global commodity markets.
Information presented on this program is believed to be factual and up-to-date, but we do not guarantee its accuracy, and it should not be regarded as complete analysis of the subjects discussed. Discussions and answers to questions do not involve the rendering of personalized investment advice, but are limited to the dissemination of general information. A professional advisor should be consulted before implementing any of the options presented. Encompass More Asset Management LLC is a registered investment advisor with the U.S. Securities and Exchange Commission and only transacts business in states where it is properly registered or is excluded or exempted from registration requirements.
Hey guys, welcome back to another episode of the Ducharme Wealth Management Podcast. Today, I am joined by Corey Hoffstein. He is the owner of Newfound Research, a quantitative investment shop. He's a published analyst and researcher in the industry and heads up return stacked ETFs. Corey brings a bunch of industry experience in addition to being, and if you're lucky enough to be watching this episode, the most handsome man in finance, I think. Otherwise, you can also find him at his podcast if you're really into the math behind finance. He's got a podcast, Flirting with Models, and the family appropriate kind. And anyways, he brings a ton of knowledge into the space. He's really built a nice name for himself on understanding this unique concept of how to manage portfolios. And today we're going to talk about that. So I hope you enjoy the episode. Corey, you've built a kind of a name for yourself in the industry on the phrase that you utilize, which is called return stacking, this portfolio construction idea that investors can utilize. It was originally sort of called, and we've talked about this before, portable alpha, kind of somewhat originally, correct me if I'm wrong here, kind of designed by the institutional team at PIMCO, sort of back in the 80s. It's just it's a totally different way of thinking about portfolios and incorporating diversification instead of just looking at things of like, oh, this has outperformed the S&P 500. This has not outperformed the S&P 500. I'll just buy S&P 500, and run the index fund, right? It's there's a deeper level of thought when you look at portfolio construction. And so I wanted to talk to you about like, what's the use case? What are some of the risks? And what are what are the considerations about that when you're putting a portfolio together as a whole? And how is it sort of achieved, right? How do you do this? So to be clear, anyone listening, I'm not recommending specifically like any particular investment or anything. Like you should have an advisor if you're going to build a portfolio like we're going to talk about today. You should talk to that advisor about that and probably get some professional help. It is somewhat of a more sophisticated way of building a portfolio. So that being said, like, could you dive into really quick, maybe like what's gone on in your career that even led you to stumble upon this, or like, how'd you learn about this originally?
Yeah, as you mentioned, this is an idea. What we've sort of generalized as the concept of return stacking was originally implemented in the 1980s by PIMCO. There's a couple other firms that were doing something similar. They didn't call it portable alpha, but it eventually earned the moniker first transportable alpha, which got shortened to portable alpha. For me in my career, what really happened is I came into the industry right before 2008. I have a firm belief most people's, the way they behave in markets is colored by their first multi-year experiences. My experiences were 2008. Gathered a deep appreciation for diversification into a decade in which you didn't need diversification at all. In fact, diversification was incredibly painful. Anything but US stocks and bonds led to significant underperformance. And I was helping manage portfolios that offered different approaches to diversification. And the constant frustration was the recognition that ex ante, people generally agree that a more diversified portfolio is better than a more concentrated portfolio. It's probably one of the few things most people actually do agree on in this industry. There are no hard and fast truths here, but that one is about as close as we can get to a fundamental law in asset management or portfolio management, that more diversification, all else held equal, is better than less. The problem is trying to get people to keep diversifying asset classes or strategies in their portfolio during a period in which they continue to relatively underperform their core stocks and bonds. And this is a big behavioral issue. In many ways, investing behaviorally sort of translates into dog years. Like 1 year of underperformance feels like 7 years when you live through it. It's easy to look at, prior returns of an investment strategy over a 5, 10, 15-year period and look at a blip of underperformance and say, oh, I could have lived through that. Actually living through it is a very difficult experience. And so what led us to adopt this more generic implementation of portable alpha was saying, well, is there a way from a portfolio construction perspective for us to introduce these diversifiers, but avoid this, what we would call the funding problem of diversification, right? That typically to add some sort of diversifying strategy or asset class, we would have to subtract stocks and bonds. But what if we didn't have to do that? What if we could keep the stocks and bonds and add the investment strategy on top as an overlay? And that's effectively what return stacking tries to do. It tries to stack the returns of alternative investment streams, asset classes, and strategies on top of the core stocks and bonds that most investors want to retain in their portfolio, and simultaneously solve two problems. One, get that additional return stream injected into the portfolio, hopefully both for its return enhancing and diversification properties, but also help solve some of this behavioral problem that investors have with sticking with diversifiers.
So to be clear, when you're like, and I am trying to look at my audience here today and say, like, this is a complex portfolio management idea, and we want to try to boil it down so that, it's like, the non portfolio nerds like ourselves can grasp the concept here. So when we're talking about the funding problem, a portfolio is like, we're going to revisit back, like, hey, I'm a moderate investor, so I got 60% stocks and 40% bonds. And that can be a mix of U.S. stocks, international, emerging markets, small cap, mid cap, growth, value, whatever. But in general, it all adds up to 60% stocks. And then you have bonds, and it might be, long dated tips or, treasuries or short-term, a little bit of short-term junk bonds, maybe, I don't know, a lot of probably ag and mortgage-backed securities, whatever, but it all adds up to 40%. And what you're saying is, if you have a return expectation on the stocks and say, okay, over the long run, I expect stocks to perform at, a net return over time, 8%, right? Like going with Jeremy Siegel's kind of stocks for the long run, kind of number. And over the long run, I would expect my bonds to produce a return of, 6%. And that's my long term. And I expect some kind of non-correlation, right? I expect my bonds to weave, when the stock market's bobbing, I want my stocks to, or I want my bonds to weave, right? And, but that correlation, man, like it changes. And in 2022, what happened is it came together, and you got smoked on your stocks and you got smoked on your bonds. And you realize, like, I didn't have a lot of diversification in my portfolio for like the first time in 20 years. You got absolutely, like, hey, actually, by the way, all investments are risk, and you got smoked on your risk side, and you got smoked on your other risk side that you didn't think was a risk side. And so what you're saying is, it's really hard for investors to say, well, okay, if I want to add 20% of my portfolio into, alternative diversifiers, do I take 20% off of stocks? Do I take 20% off of bonds? Do I take 10% off of both? And if you do, you now have to deal with, like, hey, stocks didn't go up 8% this year. Stocks went up 15% this year. And by the way, your diversifier went up 6%.
Let's use gold as an example, right? Like, gold went nowhere in the 2010s, but has been a great portfolio, had a great return over the last 30, 40 years. Very similar. You could have replaced bonds outright and actually had a better return in your portfolio. But to your point, okay, if we're going to replace some of our portfolio, some of those stocks and bonds with gold, what are we selling to make room? Right?
Yeah.
Are we selling stocks? Are we selling bonds? Are we selling a combination? How are we matching our expected return for gold with the expected return of whatever we're selling? And then what if we're wrong about those expectations, right? To your point, it might be stocks might do 8% over the long run, but they might do plus 20% next year. And can you live with the fact that you missed out on the plus 20% year? You sold some of those stocks down to buy gold that maybe was flat or negative on the year.
Mm-hmm.
And you're holding it for the long-term benefits, right? To get those long-term benefits, you got to live through the short term, which can be quite different year to year than your average expectation.
So, in principle, like if we were non-behavioral creatures, right? Like if there was no emotion about investing, it probably would be great for a portfolio to just buy some alternatives, right? And you have a little bit less stocks and have a little bit less bonds, maybe, and have the alternatives. But we're behavioral creatures that also have, not only on top of that, our own like life circumstances. So I always tell people, if you want the year where you get up 20, that means you're carrying the risk likely of the down 20, right? Like, and so looking for something that is going to try to tighten those numbers to be more consistent, right? Less volatility, if you will, is behaviorally good to help us stay the course and achieve the long-term results, right? How does somebody, so when you're looking at, okay, well, I've got a bucket of stocks, I've got a bucket of bonds, and then I want to add this bucket of alternatives. How do you achieve that without saying, I don't want to miss out on the stock return, and but I don't really know that I want to miss out on the bond return either. That's my crash protection, the stocks. I don't, what do I do?
Yeah. And by the way, I think a lot of the appetite for diversifiers and alternatives is very driven by recent returns.
Mm-hmm.
I remember early in my career, there was a huge appetite for diversifiers because we were coming out of a lost decade for stocks. It was the dot-com period and the 2008 credit crisis. During that 2000s period, international diversification worked incredibly well. Commodities were very hot. People were looking to buy the bricks, right? Emerging markets. People wanted a lot of exposure to. Long, short equity hedge fund strategies were very popular. Coming out of 2008, these macro trading strategies were very popular.
Mm-hmm. People
really appreciated and wanted that diversification because we went through a lost decade of stock returns. Bonds did quite well, but stocks, right, that 60% of the portfolio that most people have, really suffered. And then you got the 2010s where stocks could do no wrong. Oh, by the way, the stocks they were buying back then were value stocks because they had done incredibly well in the dot-com fallout. You come into the 2010s and it was a growth stock decade.
Mania.
US only, you can probably, everyone listening, even if they're not super in tune with the market, can probably name the companies that added all the returns. It was Amazon and Apple and Google and Microsoft and all the big tech names. Those were the ones that mattered.
Mm-hmm.
And if you held commodities or value or anything international, emerging markets in particular, you really suffered relative to someone who was willing to concentrate heavily into US growth and US bonds, right? And so we see these shifts and they're not predictable, not easily predictable in my opinion, but these shifts happen and these market moves are cyclical and can change. And so, people's appetite for some of this stuff is driven a little bit by their past realized experience. And I think right now we're at this inflection point of, okay, we came out of the 2010s, we hit this rough patch coming out of COVID, plus the inflation shock of 2022. We're still living through some realized inflation. Now with all the things happening politically, do we need some more diversification in the portfolio? So go back to your question, right? The question is, how do we get there? How do we start to introduce these alternatives? And again, it's you can either make room, which is this problem of selling down the things that people tend to know and understand and have experience with and have more patience with, to add in these diversifiers that tend to be more opaque and more difficult to understand, and people might not have as much of an understanding of how they should behave in different market environments. Or you need to come up with a different approach, and that different approach for us is return stacking. if you will allow me, I'm going to take a little bit of a tangent here because I actually think the best way to explain return stacking is using a totally different analogy than talking about markets for a second.
Yeah.
Because I think understanding what we're doing sometimes can get lost in the details. So for folks listening, you're probably familiar with buying a home, right? Most people will know there's sort of two ways you can go about this predominantly. Let's say there's a $1 million house that you want to buy and you have $1 million of cash. Lucky you. One of the things you can do is you can go buy that house for cash outright, and you've given your cash to someone, you've bought an asset, and your return over time will equal the return, whatever the house does in the real estate market. And maybe you sell it 5 or 10 years later, and hopefully you're at a gain, but you've been fully invested in that one single asset, and your returns are going to be driven by what that one single asset does. The other thing you could do is you could put some money down and go to the bank and get a mortgage, right? So let's say we put 20% down and get an 80% mortgage. So we put 200 grand down, borrow $800,000 to buy the house. We now have a mortgage for $800,000. We're going to have to pay an interest rate on that mortgage. But now we also have $800,000 left in cash. And we can take that $800,000 of cash and we can think about investing it. And we could invest it, say, in the stock market or in some bonds or in some combination. And now we have a portfolio where we're getting the return of the house and we're getting the return of maybe some stocks and bonds, but we have to pay this interest rate. There's a financing cost that we have to pay. And so long as the thing we invest in, right, those stocks and bonds outperform the financing rate, that mortgage cost, we can actually have a better all-in portfolio. No longer are we entirely concentrated in the house. We have stacked the return of stocks and bonds on top of the return of the house. And if those diversify each other in any way, that can be very beneficial. And if the return we generate is higher than the interest rate we have to pay in our mortgage, we've actually potentially added on extra returns as well. Now, the good news is the type of financing that's available to institutional investors is far below typical mortgage rates. Mortgage rates are typically priced at a spread above, call the risk-free rate of U.S. Treasuries, whereas institutional investors can effectively borrow at that risk-free rate. So you can get a much lower interest rate when you invest professionally in a strategy like this, in this approach. But that's the basic concept is we're using some form of borrowing to free up capital for us to invest in more things that are hopefully additional return streams to the portfolio, but importantly, diversify that core exposure. We're not going to be 100% invested in that one house anymore. We're going to invest in multiple things at once.
Well, so I think an important highlight is like the one thing that you didn't say was take the 800,000 and buy another house.
Right.
Right. Like don't buy. It's like a key to the whole concept.
Don't buy the house next door.
Yeah. Especially, right. Like, yeah, you need to buy diversification with your, freed up capital, if you will. Getting more of the same thing is just patently, that's just leveraging up. Right.
Right.
Which if you have a solid investment thesis and it's time to do that, Godspeed. I wish you well. We all know the pain and pleasure that's associated with leveraging up what in our circles we would call the beta exposure, right? So if you're a real estate investor and your metric then is sort of the real estate market, like your beta is sort of, whatever real estate's doing. If you buy, 2 houses for the price of one, using a bank loan, like you're double leverage on the real estate market. So if the real estate market goes up, you're really loving it. If the real estate market goes down, which I know a lot of you believe will never happen. I think you're wrong in that, but you would feel the pain, right? Like you would really, really feel the pain on that. And so what's different about what you're saying is you kind of, if you're pledging in your scenario, sort of, now caveat here, we would never say pledge your home as collateral to get money to invest, right? Like, but in this just easy to understand situation, it's like, you're buying something that's not real estate. Like what would do well when real estate's not doing well? What would do well real estate's doing well? It's like just what is totally not correlated to it? What has different drivers behind it, or different things that affect it performing good or bad, right? Than whatever drives the housing market in my neighborhood, right?
Right, exactly. And I think housing is an interesting one as an example, right? Because typically when you talk about buying a house, it's like, it's not just you're getting the housing market beta. You're getting one very specific house. So actually I'll go so far as to say, using leverage, if you really like real estate, to invest in a house that's very far away in a very different market that's affected by very different things, can actually still be diversifying, right?
Yeah.
I live in Florida. All the properties around me were just dramatically impacted by hurricanes last fall. The office I'm in right now was under 3 feet of water last fall, right? If I, really liked real estate, I should probably also diversify my real estate portfolio outside of Florida hurricane flood zones and make sure I go buy a house in, I don't know, Ohio, right? So that can be diversifying. And that's what a lot of real estate investors take advantage of. But most and investors in their portfolio take advantage of it. They rarely just buy one stock. But what investors don't do that real estate investors do is they don't pragmatically use leverage to diversify further, right? Using leverage for diversification can be very defensive, whereas using leverage for concentrating into more of the same exposure, can be very, very dangerous.
The thought that came into my head is like a little bit of a tangent here, but it's like, if you ended up diversifying your real estate with just real estate in different markets, right? Like all over the US, eventually you just come up with like the index fund of US real estate, right? Like this is the same idea as like why you own, an index fund, versus owning, single names, right? It just popped into my head. Some things.
Yeah, well, and then you're sensitive to a 2008 housing crisis crash, right?
Just like you are in an index fund. Yeah. You get rid of the idiosyncratic risk, right? Like, what if the hurricane hits my neighborhood? You've gotten rid of that risk, but you don't get rid of the risk of what if the entire country's in a severe economic recession, right? A much harder risk to diversify against, right? And so when somebody's looking to diversify away from these huge major economic things, like where you have huge asset classes kind of moving in synchronization, so to speak, like, where does somebody look? Like, what are you mentioned gold, but what are some of the other opportunities people have, right? Because people think stocks, bonds, if it's not going to be either that, I'm buying real estate, and some people do think gold. We've kind of talked about all four, but I think there's other opportunities.
Yeah, stocks, bonds, real estate, gold. I'll name a couple more, but I do think it's worth pointing out, right? You talked about this risk of right? You're in the housing market, for example, 2008 comes around and you got to ride that roller coaster down. At the end of the day, we have to take some risk in our portfolio to earn a reward. The only reason we have the expectation of markets going up over time is because we're bearing risk. We're getting paid to bear risk. That's why you expect these things to go up. That's why you get paid coupons or bonds, because there's some sort of default risk or time value of your money. So, I want to emphasize that you can't get rid of all the risk in your portfolio. You have to be willing to bear some risk. It's just a question of how much can you spread it out among different bets. Well, so you mentioned, right, stocks, bonds, real estate, gold, broader commodities tend to do well during inflationary periods. And then there's different hedge fund style strategies. Long short equity, for example, that will go buy some names, like might buy Coca-Cola and Procter and Gamble, and go short names that they think will underperform. And in doing so, you're not taking market risk, you're taking this selection risk. And so you can have a very different return stream. There's macro trading strategies that will trade stocks, bonds, currencies, and commodities from all over the world and trade those markets long and short based on a variety of signals. A really popular one is trend following, where it'll buy markets that are recently going up and sell markets that are recently going down, and actually sell them short. Very flexible, globally allocated sort of hedge fund-like strategy that is available to a lot of investors in a mutual fund or exchange traded fund today. So there's all these alternative asset classes, catastrophe bonds, cryptocurrencies that represent unique risk profiles and do different things. And then there are there's strategies, hedge fund strategies, merger arbitrage, litigation financing, things that are just typically very uncorrelated with what's going on with the general market, that depending on who you are and what you have access to, they can be wrapped up in public vehicles like a mutual fund or an ETF, or you might have to go look at a private investment, but they are out there.
So one of the things, like when you mentioned, okay, so trend following, you can get, these ideas that use something like trend following to trade a selection of instruments, typically some kind of, equity, bond, currency, and interest rate exposure. That it is trending, and it's because we know that when markets can trend, and when they trend well, right? And the old saying, like, the trend is your friend until it ends, which is why you want to have some kind of active. If you're going to trend follow, you have to have some kind of active off ramp, right? To select. But because diversification's been so poor, right? Particularly relative to, like, hey, the S&P was the game, like, you know what I mean? It's done so well for so long. Why would I buy something that's this trend following ETF that, has underperformed the S&P 500? Like, again, look, this active manager underperformed the S&P 500. What's your, like, how should an investor be thinking through that? Maybe from a different lens, or you put in some different thoughts as something like that.
Yeah, trend following is a great example. It's one of my favorite strategies. Again, the way trend following works at its most basic levels, you're getting access to global equity markets, global bond markets, global currency markets, and global commodity markets. And you're going to trade all of these markets. You're going to trade things like gold and oil and the yen and the euro and German bonds and euro stocks and all this sort of stuff, long and short. You're going to go long these markets when they've been trending upwards, and you're going to go short these markets when they've been trending downwards. And so it's a directional strategy, right? You could be net long stocks, you could be net short stocks, net long bonds, net short bonds, et cetera. But it's a very adaptive, highly adaptive strategy, and has historically tended to generate positive returns during significant equity bear markets, as well as positive returns during inflationary periods. So it did very well in the 2000s, very well in 2008, did very well in 2022. So it's a very attractive, historically attractive diversifier to a portfolio, because it not only taps into all these global asset classes that most investors don't have in their portfolio, but it does so with a very dynamic trading strategy that creates a return profile that has historically been very uncorrelated with typical stocks and bonds. Now, the question is, how do you put it in your portfolio? Well, you do it one of two ways, in my opinion. You can either try to sell some stocks and bonds and make room, in which case we're back to this fundamental behavioral problem, right? Where you would have loved this exposure in the 2000s and absolutely hated it in the 2010s, because just like stocks went through a lost decade in the 2000s, managed futures trend following went through a lost decade in the 2010s. And so you would have been sitting there watching stocks and bonds just go up as your managed futures exposure basically went sideways. It had a couple of positive years. 2014, 2015 was a good period, but by and large, it just went nowhere. That's going to be very frustrating and likely going to lead people to sell out of managed futures long before they would have seen the benefits in a year like 2022. And in fact, if you go look at industry reports like the Morningstar Behavior Gap Report, what they find is they track flows into different mutual fund categories to see what the actual investment return is, what's the return of the fund, versus what's the average dollar actually earn. And what they find in categories like managed futures is that there's this huge behavior gap. In 2023, I think the prior 3-year, 5-year annualized return for managed futures was about 6%. The average dollar only earned 3%. And the reason it only earned 3% was because it was performance chasing in and out. It got into managed futures too late, sold out too late. Instead of making it a permanent strategic allocation in the portfolio, you had people mistiming it and missing a lot of the returns. And so there's a 300 basis point or 3 percentage point return gap that investors actually underperform by. So the second option is what we call return stacking, which is you use some of the tools that are out there, and we can go into how this works in practice potentially, but to effectively stack the returns on managed futures on top of your portfolio. So if you're a 60-40 investor, instead of maybe selling 10% of your stocks and 10% of your bonds and buying 20% managed futures and becoming 50-30-20, you could stay 60-40 and add a 20% allocation of managed futures on top. And then in a decade where managed futures go nowhere, you don't potentially even notice. Day to day, week to week, you'll notice a little more volatility in your portfolio, but you won't really notice over the decade that you underperformed because you still have those core stocks and bonds. And then you're able to maintain that exposure so that in a year like 2022, when stocks and bonds are both down, but managed futures is up 20, 30, 40%, depending on the manager, right? You can realize that benefit in your portfolio.
How does somebody get to that? Because if it was just as easy as, yeah, I add it to my portfolio and it just appears, well, I'd like to put 6%, average annualized return on top of my returns, yeah, I have it. There's some more construction that goes into that, right? So how does somebody?
Yeah. So the question is, how do we free up the room, right? Yep. You only have $100. How do you get $120 of exposure? Well, you have to effectively borrow that $20. And there's many, many ways in which you can do it. But what's interesting today is there's suites of ETFs and mutual funds that allow you to get that exposure. So as a very simple example, there's an ETF out there that gives you 2 times exposure to the S&P 500. Every dollar you put in it, you're going to get $2 of exposure to the S&P 500. Well, what does that mean? Well, it means if you're a 60-40 investor, 60% stocks, 40% bonds, and allow me to assume all those stocks are just S&P 500 to make my life easy.
Sure.
You could replace that entire 60% position with 30% in this 2 times ETF. And it would, just putting 30% of your money in that ETF, because it gives you 2 times exposure, give you the effective exposure of 60%.
Yep.
But now what you've done is you've freed up 30% of your money with which you can do a variety of things. And if you went out and bought, let's say, a managed futures fund with that 30%, what you're left with is now 60% stocks when you x-ray the portfolio, right? 60% stocks, 40% bonds, and now a 30% exposure on top of this managed futures fund. Now, there's a lot of implementation wrinkles and nuances to think about how this all works, but that's a really basic example of you're using some of these tools that have the leverage embedded in them to free up capital in your portfolio so that you can invest in the diversifiers. But when you x-ray through all the holdings, you've maintained the core stocks and bonds that you had at the beginning. You
gave away the whole secret there, man. You can buy all this stuff through through ETFs these days.
It's amazing what the market has come to. I wrote an article. I didn't write an article, excuse me. I was invited to participate in a Barron's Roundtable back in 2017. And I said, the term we would use in the industry is capital efficiency. And I said, I thought capital efficiency ETFs were the future of ETFs.
Yeah.
And I don't think I'm right yet. Like, they're not the future, but we have seen an explosion of these offerings in the last couple of years that really create a huge amount of flexibility for investors when used thoughtfully.
Well, I think they're rearing their head as add leverage to everything. There's a leveraged ETF out there, I think, for just almost anything you can dream up at this point, right? And it probably goes for just about any. I think I saw the other day, there's an ETF now for like the recreation of space technology or something. Companies that are investing in that. And it's just like wild, like, I didn't think I was going to see something that seemed more stupid than pot stocks. And there it is, right? Like the market never ceases to amaze me that if somebody can dream it up, they're going to launch a financial product. And it's going to be out there for people to invest in and whatever. There's so much out there. But what opened my eyes was viewing it all through the capital efficiency, right? So if you use like margin in a brokerage account, it's actually like more expensive sometimes than using the embedded leverage access institutionally in existing products. And if you use that in the way that we're talking, where it's like you're using it to buy the appropriate amount of total exposure, and then you're freeing up capital to buy other assets, that is particularly if they're non-correlated, right, is a more prudent way of, I think, accessing those more advanced instruments, right? Still not for everyone, still carry some risk. And you should be aware of those risks, right? Particularly, I think one of them is like anytime you have a leverage fund, right? Like there's derivatives involved that, in an insane market environment, if the fund that's putting those together isn't being managed properly or decides to rebalance, right? Look no further than Volmageddon in 2018 to understand what can happen to funds. It's you got to understand, you got to work with the right fund companies. You have to understand how stuff's built. And more importantly, I think you also have to understand, like, what else are you buying with that? So, okay, so now you've gathered some capital efficiency, but you can't just hold cash and you can't go buy T-bills, because T-bills is generally like really similar to the financing cost on these more, these products designed for capital efficiency. So how does somebody start to look and understand, well, how do I determine if something like non-correlated or even like more importantly, maybe like, how do I determine if something is correlated and like, maybe that should be a concern to me?
Yeah, it's a great question because again, you want to avoid adding more of the same to your portfolio, and I think that's why a lot of these levered ETFs get a really bad reputation, is because you look at something like 3 times Nasdaq. That's a highly volatile portfolio on its own. And if you were to say, well, I'm going to replace my stocks, my 60% stocks, with a 60% position in 3 times Nasdaq, well, now I'm 180% exposed to the Nasdaq, and that's probably very dangerous. Versus, again, if I use that very highly levered instrument to put 20% of my money into that, which gets me back to the 60, and then I free up the 40% to do other things, right? That's a very different expression of leverage. Leverage, I think rightfully so. A lot of people look at leverage as being risky. And if you look at every major financial catastrophe, probably in the history of the world, leverage is usually at the scene of the crime. Mm-hmm. But it's rarely there alone. It's typically there with some form of illiquidity or concentration risk or just outright being excessive. And actually, interestingly, if you look at other examples, some of the most robust hedge funds in the world, the Bridgewater All-Weather Fund, for example, uses a lot of leverage, but it does so it can diversify its investments across a huge range of categories, mm-hmm. right? To try to create an amount of breadth to make a much more stable table. It's not a 3-legged stool, it's a 50-legged stool that they think will be able to continue operating through any sort of economic regime. So to go back to your question, all right, how do you find those different legs that can truly operate differently in different market environments? And there's two approaches here. The first is just with data, right? There is a lot of financial data out there. There's a lot of research on different asset classes. You can go compare visually, typically, how did gold look versus how did bonds look versus how did equities look? Let's go look at equity stress events. Mm-hmm. When did equities crash? How did gold do? When did bonds crash? How did gold do? Do these things seem related? You can crunch the numbers, actually, in Excel, go calculate correlation. But the other way about this is to think fundamentally, right? For things like stocks and bonds, what are the fundamental drivers behind them? When should they do well? When should cash flows dry up? And then think about similarly for different other asset classes or strategies, are they tied to the same thing? One example I mentioned is catastrophe bonds, right? Where you're getting, you're basically offering insurance for these things like hurricanes, right? Pointing out my window here. Should that be fundamentally correlated to what's happening in equity or bond markets? Probably not, right? It's a weather event. There's no reason you would expect a hurricane to have anything to do with an economic recession or inflation, right? Should be totally independent. And so you can look at fundamental drivers really as being the important point, and then obviously, always dig through data to find out whether that's played out historically.
Yeah. I think like one of the risks to be aware of and understand is the idea though that like, although the weather event shouldn't be correlated with the recession, right? That doesn't mean that they won't ever happen at the same time. It just means
I think that is such a good point. And I'm sorry to cut you off there, but so many people think uncorrelated means negatively correlated, right? And all uncorrelated means is if you tell me something has happened, right? It doesn't give me any information about the thing that's uncorrelated to it, right? Mm-hmm. So if you say the weather and the stock market are uncorrelated and the stock market just had a 50% drawdown over the last year, that doesn't provide me any information about what the weather has done. And it's a coin flip as to whether there was a hurricane or not. And so I think people need to understand that uncorrelated is great, but it doesn't mean that they can't go down at the same time. And so managing that total leverage in their portfolio remains incredibly important.
Well, I think it adds context to the idea that if you use this portfolio methodology, of which I'm a fan, and my clients, if you look at their portfolios, they would realize that this is how we manage for the most part. But it can add to the overall volatility in the short term. But what it should do is enhance the return over time. But proof and price don't always come at the same time. It's kind of one of the sayings on the street. And so you have to sort of stick with it. There's times when the non-correlation will play out to your favor. And so while your stocks are down, your trend following system's doing great. And that's giving your portfolio sort of ballast, and it makes it look like you're outperforming. And when things are going up, again, stocks will be going up, trend following is going great, but stocks aren't making the trend following work, right? Like the fundamental drivers, like you're saying, are different. And so again, looks like you outperform, but the same can be flipped, right? So stocks can be down. Again, there's no fundamental driver that makes it a bad time for trend following. But now if your trend following's down and stocks are down and you had that leverage on, right, now it looks like you're really underperforming, right? And you're losing faster than the market per se. And, then also when like stocks are up, but trend following's down, you look like you're underperforming on the upside, right? So all of a sudden this non-correlation can correlate. It can, the two things that are not correlated can still happen at the same time, but you have to zoom out and say, okay, what this means is I have diversification, and over time it should work out just fine. And I think one of the biggest things to remember is your hurdle rate on your diversification is not, I could have bought more S&P 500, right? Like that's sort of what I was getting at earlier when I was like, how should people look at a trend following managed futures ETF, when they look at it and they say, oh, it's on, it did 8% last year and S&P 500 did 20 or whatever, right? It's like the managed futures, what a dumb idea. Who's investing in that? It's like, well, I don't know, maybe the institution that was borrowing money at 4% to buy it, and so they got their S&P return, plus they got the 8% in the managed futures idea, minus the 4%, interest expense on the money they sort of borrowed to own it. Right. And that's where the stacking comes in. Right. And so the stack can work in your favor in the short term, and it can work against you in the short term. But the idea is over time, if your diversifiers are beating sort of the cash rate, which is not a high hurdle, right? It's not an incredibly high hurdle. You definitely don't want to try to take gambles on that, but it's not an impossible task. You can add some extra value, right?
Yeah, the thing I typically say is people, especially where interest rates have gone up, people say, well, cash does actually seem like a high hurdle rate. And I'd say, well, the reality is, Finance 101 is you wouldn't invest in anything unless you thought it was going to outperform cash. And that's not strictly true when we get to Finance 201 and 301. You buy insurance for a reason, right?
Right.
And insurance is certainly expected to underperform cash. So that's not strictly true at a portfolio level, but generally speaking, like you only try to invest in things that outperform cash. I want to go back to something you were talking about, was especially with managed futures as an example, and stocks and them zigging and zagging at different times. On a day-to-day basis, you almost expect, right? Stocks up and managed futures up should happen a quarter of the time. Stocks up, managed futures down should happen a quarter of the time, right? Stocks down, managed futures up a quarter. Them both down should happen a quarter of the time. As you start to look at longer periods, that's where the numbers skew, because historically both managed futures and stocks have gone up. So if we look at rolling 3-month periods over the last 25 years, over those rolling 3-month periods, stocks and managed futures have been up about 37% of the time. Stocks have been up and managed futures have been down 35% of the time, right? So very similar, a slight edge to them both being up. But there's about 17, 18% of the time where stocks have been down and managed futures have been up, and only about 11% of the time that they've both been down over any 3-month period. But it still happens, right? The point is, you're not totally eliminating by just being uncorrelated the risk that these both go down and you look like you're underperforming. These are meant to be hopefully long-term investments and long-term advantages. And you can't look every day, every week, every month to look for that benefit to compound. You need to have it in your portfolio over time for the benefits of diversification to work.
You got to stay the course, right? I mean, that's just, if you're not a long-term investor, don't kid yourself and say you're a long-term investor. Right? I think people are guilty so often of saying, I'm a long-term investor. I've got 3 years. Like, realistically, it's like, that's not a long-term investor. That's midterm at best, and I think that's where sometimes traders have the real edge, right? Is that they can trade instruments that give a better return than cash, and they can manage their risks so that they're not taking excessive risk and they're not experiencing those drawdowns that would be the risk of that a midterm or shorter term investor couldn't handle. But most people aren't traders, and so, like, just be honest with yourself and say, okay, if I have short term money, I'm okay making cash plus, right? Or a really modest return, regardless of whatever the equity markets do. Because if it's gonna go up, yeah, I'm gonna be jealous. I should, wish I would have, right? But if I'm gonna be down, if the equity markets are down, I'm gonna be like really happy and grateful that, man, good thing I didn't. So just be honest with yourself, and then make a prudent decision around it. And if you are truly a long-term investor, then I think looking for an idea like Portable Alpha is a really interesting portfolio idea. Like what has your research shown? Like why do Portable Alpha rather than, like, hey, I'm going to press the Mag 7. I'm going to buy more tech stock. I'm going to buy more of the beta, more of the stock market that's working, or I'm going to, find my strategy to pick the right stocks. Why run something like managed futures overlay or Portable Alpha? Why run that instead of just, pick the best stocks, right? Why not get good at that?
And listen, if you can pick the best stocks, by all means, go ahead and do it. The reality is there's this interesting conundrum, which is when you look at, say, global equity allocations today, the US on a market cap weighted basis makes up 60% of the global index.
Yep.
So when you talk to your average investor around the world, 60% of their equity money is in the US, and the vast majority of that is in US large cap. So you have a huge amount of money around the world allocated to US large caps, all of which would love to beat the average US large cap investor, right?
Yeah.
But all pursuing alpha, fishing in the same pond. And that tautologically makes it incredibly efficient. Everyone's looking for alpha in the same place, which makes alpha harder to find because there's so many people who are trying to pull it out and pull out every penny of it, which is why when you look at something like the S&P SPIVA report or the Morningstar Active Passive Barometer, you'll find that over the prior 15 years, only 10% of active managers have actually beat the benchmark, right? It's so picking stocks is incredibly difficult, and picking managers who can beat the market is incredibly difficult. And that's not to say there aren't people who have the ability to do it on both of those. But I look in the mirror and say, I don't think I have that skill or that edge. But what I can do with my portfolio is say, I'm just going to buy the equity beta because I do want that beta. I do think I get paid for it over the long run, and use capital efficiency and portfolio and portable alpha to introduce diversifying return streams on top. And I can buy a mix of gold and merger arbitrage and managed futures and carry strategies and create a diversified alternative portfolio that I think is going to beat cash more consistently over the long run than I can find a manager who can actually deliver alpha consistently over the long run. The probability of me achieving that with the portfolio I built, I think, is far, far higher for the skills I have.
It's I view it as a more winnable game. It introduces the opportunity to be more painful in the short term, but I don't think it introduces, and I don't have any math behind this. If you do, please share. It really doesn't introduce more pain than a concentrated stock portfolio of trying to pick the outperformers, right? Because of the volatility increase and idiosyncratic risk that becomes associated with it, right? Like that. Talk about something that when stocks are great, it can be great. And when stocks are bad, it can be really bad. And sometimes when stocks are great, it can also be really bad. And sometimes when stocks are bad, it can also be really good, right? Like it just depends on what you're overweighted to, underweighted to, just like anything else. But it's, give me a hurdle rate of the S&P 500. It's tough. Give me a hurdle rate of cash. It's a more winnable game. That's sort of what.
Absolutely.
You know what I mean?
What's interesting, right? When you look at it in isolation, let's say you had a fund that for every dollar you gave them, it gave you $1 of the S&P 500 and $1 of managed futures. That fund in and of itself would be higher volatility than just the S&P, right? Mm-hmm. The S&P called long-term vol, the S&P somewhere around 16, 15. The long-term vol of that fund would likely be around 20%. So it is going to be day-to-day more volatile.
Yep.
But to your point, so is a concentrated stock portfolio. And when you look at it at the total portfolio level, right, you're not putting 100% of your money in this thing. Let's say of your 60-40, you put 20% of your money in. So you now have a 60-40-20. That 60-40-20 may not actually be more volatile than your original 60-40 at the portfolio level.
Yeah. Because
the managed futures overlay has historically been so uncorrelated to stocks and bonds.
Yep. It's our mutual friend is Steve Rubel. Like I remember a couple of years ago, he just looked at me and he said, "Yep, well, I mean, doesn't it all come back to position sizing?" And that has absolutely stuck with me. It's all about position sizing, because right where you said, like, so where my head goes is like, okay, instead of a 15 vol, I got a 20 vol. But what if I owned only 3/4 of it? You know, it's like, back to the capital efficiency conversation. So now I'm back to what my initial volatility was, but what's my return expectation on upside capture, right? How much of the market return am I still capturing? And what is my downside capture? When the market's down, what am I really doing? And does that become more efficient to own own stuff that way, than just own, the old, I don't know, what do people say? Like the VTI and chill or whatever, right? Like,
right.
Anyways, Morningstar, I think, has an argument against why that's a good idea, but it's a different episode. Anyways, well, I appreciate, it's not every day that I can convince the most handsome man in finance to take an hour out of his day and talk portable alpha with me on a podcast. But Corey, I appreciate it.
I appreciate the opportunity and the flattery.
You're out there doing you're doing the good work. And I appreciate people that are trying to add value and educate investors. I think it's awesome because you can educate investors till the end of the world, like just till we're blue in the face. And behaviorally, so many of them will still just do the wrong thing, that we can tell everyone exactly what they should do to be successful. And most people still won't listen. And that's what creates alpha. And that's what creates the risk premium that we get paid to bear. Right.
Absolutely.
So it's, you still win the game, right? Even trying to add value along the way. So I appreciate you hopping on, and we'll make sure to get together soon, and see you around, man.
Sounds great. Thanks.